the first one you mentioned was credit. And so from a credit perspective, how important is that when you're applying for a loan?
There's really nothing more important besides maybe assets, but credit is crucial to buying a home, whether it's your first home or second or investment property. The minimum credit score is a 640 that you have to have. There are programs that go down to 600 FHA programs, but those are primary residents, and the interest rates are all higher. Of course, when you have a lower credit score, you're going to pay a higher interest rate to offset the credit. So, I always say, shoot for 640. You really need to get in the door at 640, get yourself up to that score. If you can get above a 700, and then you're doing really well with the interest rate. So the lower your credit score is going to be reflected in a higher rate. So you want to, do well for yourself and get yourself into a higher credit score so you can get the best rate available.
What's up, everyone? This is Niyi Adewale, host of the Ekabo Home Financial Freedom Mastermind Group. This group meets virtually every Wednesday at 7 p.m. Eastern, and the members of this group are committed to achieving financial freedom well before the traditional retirement age. So in this podcast, you are going to get VIP access to the conversations we have about different forms of investment and creative ways to get your dollars working harder for you than you originally worked to obtain those dollars. Today, we're joined by Tracey Long, who has been in the mortgage industry for over 25 years. She's been originating loans and working every portion that you can think of within this. And we're so happy to have you here, Tracey. Thanks for joining us.
Thanks for having me.
Of course. I really want to learn more about your background. How did you get started in this industry?
So when I graduated college in 1994, and this was my first job out of college. It really, my major was not in finance and business, but I kind of fell into it. My father was in mortgages, and he was like, why don't you give it a shot? And I did, and I absolutely loved it. And one of the things that I think I love the most about it is just being able to help people fulfill their homeownership dreams. It's just very, it's a great feeling to see somebody kind of either buy their first house, or whether it's investment property or second home, kind of, meeting their financial dreams and being a part of that. So.
Absolutely. And it's something that can keep you going and keep you, motivated through the ups and downs. And I believe you own a couple of properties as well too, right?
I do, yeah. I've got the primary residence, and then a second home, and then an investment property. So I've got 3, yeah. Nice.
You are in good company on this call. A lot of the members invest in real estate actively and look to build that portfolio. So we love our lenders, and it's great to have you on. And
Great.
Prior to this call, when we were talking, you shared with me 4 key areas that aspiring homeowners and investors really need to pay attention to and navigate if they want to get qualified for a home loan. And I really want to dive in and spend time on each of these areas and tap into your wealth of experience. And the first one you mentioned was credit. And so from a credit perspective, how important is that when you're applying for a loan?
There's really nothing more important besides maybe assets, but credit is crucial to buying a home, whether it's your first home or second or investment property. The minimum credit score is a 640 that you have to have. There are programs that go down to 600 FHA programs, but those are primary residents, and the interest rates are all higher. Of course, when you have a lower credit score, you're going to pay a higher interest rate to offset the credit. So, I always say, shoot for 640. You really need to get in the door at 640, get yourself up to that score. If you can get above a 700, and then you're doing really well with the interest rate. So the lower your credit score is going to be reflected in a higher rate. So you want to, do well for yourself and get yourself into a higher credit score so you can get the best rate available.
That's powerful. And when you look at the rates, right? You mentioned 640 being that minimum unless you move into an FHA type of loan, first time home buyer loan. Is there a range when it comes to rates? Like, hey, if you're between X and X, you can get this rate. If you're between X and X, you get this rate.
Yeah, I mean, as you know, interest rates fluctuate daily, and especially lately, it's been very volatile. But interest rates on an FHA loan, because it's a government-backed loan, they're going to be lower. With a good credit score, 3.5% down minimum is your down payment for an FHA loan. You could be looking in the mid threes. And then, conventional loans, you're looking probably I always say for conventional, really, you should be at like 660, 680 or above. Anything below that, you're really kind of best suited for an FHA loan. But 660, 680 and above, you're looking anywhere from like 4% today, 4.125. It's just, unfortunately, rates are going up, and it's just going to continue that way, unfortunately, I believe.
Of course. And I definitely want to get into that piece. And again, just to qualify, this is Tracey speaking. This is not, we're not legal advice, anything like that. But just tapping into your knowledge from what you've been doing in the mortgage industry as well. And so from a credit aspect, that makes a lot of sense. And what would you consider stellar credit? Where does stellar credit start out in that range of 640 to X?
Really, 740 and above is stellar credit. You're going to be eligible for best pricing available with a 740 and above.
Okay. Yeah. Okay. I appreciate that. Okay. So that was tip number one, right? When navigating toward loans, and you had 4 tips. The second one was the cost associated with purchasing your home and really understanding that. What are some of those costs that people don't really think about when they're buying a home, or the most important cost that you need to focus on?
Right. So, when you're looking at buying a home, you're looking at the most frequent question I get is, how much is my down payment? Okay, so that, on an FHA loan, your minimum down payment is going to be 3.5%. So the simplest way to think about that is, round numbers, $100,000 sales price, 3.5% of that is $3,500. So you can do the math according to whatever sales price. And then you're looking at, for example, like a conventional loan. There is a first-time home buyer conventional product, 3% down, which is better than the original. The usually it's conventional is 5% down, but I've been doing more and more 3% down loans, for first-time home buyers. But nowadays, because it's such a competitive environment right now, you're looking at down payment, but then also you're looking at potentially paying your own closing costs, because the seller is looking at 15, 20, in some cases 60 offers, and they're going to pick the one that is the best for them, which oftentimes means that you're going to wind up paying your down payment and your own closing costs. But to kind of back up for a second, really what you're looking at is, when you see a house and you find the house, first thing you want to do once you go under contract is get it home inspected. Make sure that the house is sound, it's a good condition. A good home inspection is going to cost anywhere between, $400, $500. Okay. So, and that is, your first kind of like kick the tires, make sure that the house is in good condition. And then once you pass your due diligence period, then we order the appraisal. Cost for the appraisal is ranging from different lenders, but anywhere between $400 to $500 is typical cost for the appraisal. And then you've got your earnest money. Don't forget your earnest money. You've got to put your earnest money down just to show the seller you're in good faith, you're serious about the house. And that is usually 1% per 100,000 of sales price. So $200,000 sales price, you could be looking at $2,000 of earnest money. So in some cases you can negotiate less than that, but so those are kind of like the bullet points of like what to expect when you are getting out there to look for a house and going under contract. And it's like, that's why I always kind of advise my clients, if you think you have enough and you're just meeting your budget, save more, because moving costs money too. So you want to you don't want to spend everything on your down payment. Worst case scenario, if you have to pay your own closing costs and the seller's not kicking in any, and you've got your home inspection, your appraisal. So there's a lot of costs to consider.
Absolutely. And I want to touch on a couple of things that you just mentioned. One of them being the closing cost piece, right? In this market, I can attest, I've been working with 3 or 4 clients. We've been putting offers daily, and it's competitive. We're over asking, hey, we'll cover our own closing. And people are like, hey, we're not having it, right? And so it's definitely competitive out there. It's a seller's market.
Yeah.
And I want to dig into a couple things that you mentioned. So when you talk about the earnest money deposit that you put down, what is the significance of that, and why do you have to put that money down? And also, can you walk through how that relates to the due diligence period?
Yeah. So why it's important, it's just how it works. An earnest money deposit means that you're a serious buyer. And so the seller will will retain that earnest money and, basically keep that through the due diligence period. So for example, if your contract is written in a 7-day due diligence period and you do your home inspection and you decide, this is not the house for us, I want to go ahead and back out, then you can get your earnest money back as long as you're inside your due diligence period. If you exceed the due diligence period, it's really kind of a one-off call of the agents if they can work it out and you get your earnest money back. I would say predominantly most agents really don't want to keep and sellers wouldn't want to keep the earnest money. It just doesn't leave a good taste in everybody's mouth. So you don't really want to do that unless you're riding it all the way close to closing and then something happens. Okay, I've seen situations like that, but most of the time, even if you're outside of your due diligence period, you're going to get it back. But it's still a little bit dicey. You really don't want to exceed your due diligence period. So it's that's the significance of the earnest money. Yeah.
Absolutely. And 100% agree. It's one of those things where everybody wants this to go through and for both sides to be happy. That being said, don't push it. Use your due diligence period to figure out if you want to move forward. And after that period, it's really dicey on getting that earnest money back if you need to.
That's right.
Another thing that you mentioned was that closing cost. This is something I've seen, and it actually caught me by surprise when I first bought my first house, right? Because this is something I didn't factor in. I'm like, okay, I'm doing FHA, 3.5% down. I have it saved up. And then I come to closing and realize, hey, I need to get some gift money because I don't have, X amount for closing. So on a typical basis, if you had to give a percentage, say you're buying $100,000 house, right? Or really, in this market, let's say you're buying a $200,000 house, first time home buyer, roughly what percent of that would you need to bring to closing, or how much would you need to have aside for closing costs?
For just closing, I mean, the rule of thumb is usually about 3%. So in that scenario, you'd be looking at, $6,000 roughly. I always say, really, it's case by case. That's why I always have my clients send me the address. If you're interested in a property, just send me the address so I can pull the tax bill. I've seen in some cases where, I can do a best guesstimate of what I think your closing costs are going to be. But then we pull the tax bill and whoa, wait a second, taxes are really much more on this property than we thought. And so we want to be prepared with that. But I'd say that the rule of thumb is anywhere between 3 and 4%. You can't ask for more than 3% on conventional loans anyways. FHA is up to 6%. So that an agent can ask for max 6% closing costs to be paid on an FHA loan, max 3% on a conventional loan. And really, for the borrower who really needs their closing costs paid, another kind of workaround on this would be, for example, if the closing costs are going to be $7,000, sales price is $300, you could actually increase the sales price and offer $307, and then back in your closing costs. And the seller really doesn't care because they're netting the same number.
And Tracey, I love that because that's literally a strategy that I employ with a lot of my buyers. In this market, it's a little tougher. We can't just offer that. We got to go even higher to get it. Yeah. And that's a great strategy for keeping some more money in your pocket. Because at the end of the day, an extra $10,000 added to a 30-year loan, what does that roughly equate to in a monthly payment?
Very little. Yeah, not much at all. Where if it helps the buyer get into the home, and I mean, it might be very little, a couple dollars worth of interest, not much at $10,000 to not take that deal and build it in, as opposed to just staying renting because you don't have enough to be able to pay the closing costs. Yeah. Agreed.
And the one risk factor that could come into play, and I know that you know this, but just for the broader listeners, is if you go too high you can start to run into, will the house appraise, right? And so when sellers are looking at this and they're comparing offers, if yours is astronomically high, but you're getting all closing costs covered, and somebody else's is more in the range and they're not getting closing costs covered, they may go with that other offer just because appraisal, if it comes back lower, it could be an issue from them.
That's right. Right. And so the appraisal contingency is important to protect the buyer, to make sure that, and then if there's no appraisal contingency, then you just have to know that's the amount of money that extra that you're bringing to closing, and you have to have that liquid and ready to go.
Absolutely. And one piece that you mentioned before is after the due diligence period is when you typically order the appraisal. And how does that process work? What does that look like from ordering the appraisal to getting it back and reviewing it?
Anywhere from 7 to 10 business days. So, and I always emphasize business days. So, it's not a weekend. It's, the business day matters. 5 to 7 business days, and I'll order it right out of the gate. As soon as I get the green light from the home inspection, we don't want to wait, because, it's an important piece. The appraisal is just as important as, the financing and getting the loan through underwriting quickly. If there's going to be any issues, typically there aren't, because I myself and any good lender, they're going to vet their borrowers really well up front to make sure that there's no surprises on the back end. These are things that you really want to order the appraisal up front, just right after the home inspection is completed.
And I can attest to good lenders. Tracey's actually somebody I go to often with questions, and also sending clients to say, hey, get a pre-approval with Tracey, because she's going to go through thoroughly and tell you exactly what's needed. So I definitely appreciate you. Shout out to Tracey. So we talked through the first 2 steps, right? And there's 4 total, and that you need to really focus on to qualify for a loan. The first one we talked about was credit. The second one we talked about were the costs associated with purchasing a home, making sure that you're saving up enough for that. The third one is one that I really want to spend some time in, and that's the different types of loan programs out there. So you alluded to it a little bit earlier, but now I want to dive into each and kind of understand the differences, starting with the FHA.
Okay. So the FHA is a government-backed loan. It is traditionally more, lenient in terms of credit qualifications. It is more expensive. I'll say that it's not that much more expensive than a conventional loan, because the interest rates are lower. So the mortgage insurance, what I always say the key difference between FHA and conventional is that FHA, you're going to be paying mortgage insurance for the life of the loan. So it is a declining mortgage insurance. It's going to go down over time, but and it's a portion, it's a percentage of the balance, but it will never drop off, as opposed to conventional, where you get to 80% loan to value and you can drop off the mortgage insurance, which is a huge benefit. If you imagine, spending $200 a month and mortgage insurance, and that adds up, and it's not benefiting you at all. So, the FHA loan is great. It's a 3.5% minimum down payment. And so, it's great for the borrower who's maybe a first-time home buyer building credit. Under 700 score, under a 660 score, gives them the opportunity to get into a house relatively cheaply, Mm-hmm. Other differences are to be aware of would be the appraisals are different, and there's more, I guess, because it's a government-backed loan, it is a little bit pickier in terms of appraisal and kind of what they require. So if you're a borrower and you're considering what is the best loan for me, I often will say, really, if you can, you should qualify for conventional, because it's just going to look better as an offer coming in and being considered. But the FHA, they can be pickier. And for example, one criteria of the appraisal that, I don't know, it's one of those interesting one-offs with FHA. I don't know why it exists, but when you have a stairway walking up into a house, it has to have a railing. Why? I don't know why. It's just always been that way. But these are little one-offs that, from the seller's perspective, might turn you away from an FHA borrower. And so an agent will advise, okay, this house is going to go FHA, no problem, and knowing the guidelines. But then a conventional you pretty much, it's going to appraise and you're fine. It's just an easier appraisal process. Other differences, I think that's pretty much it between FHA and conventional.
Agreed.
I mean, sorry, on the FHA loan. Yeah.
No, and on that piece, I've actually worked with a couple clients where it didn't appraise and we had to come back and kind of fight. And Tracey, actually one of them was with you, and we had to come back and try to fight. And thankfully we were able to get the house. But to your point, from a seller's perspective in a competitive market, if they have the same offer, one FHA, one conventional, 9 times out of 10, maybe 10 out of 10, they're going to go with the conventional loan, just because it's a little bit easier to kind of get that deal closed.
Right.
One point of clarification for those that do not know, what is mortgage insurance, and why is it applied to an FHA loan, and when is it applied?
So mortgage insurance, it's kind of astonishing. A lot of people don't know this, but basically mortgage insurance, you're going to pay 2 parts of mortgage insurance. When you get a mortgage and you're doing an FHA loan, there's what's called an upfront funding fee, and everybody pays it in the United States who gets an FHA loan, and it is 1.85% of the total loan amount, and it is financed on top of your loan. And that's just money that you're just paying to the FHA, to Federal Housing Administration. And then there's your monthly mortgage insurance, which is just built into your mortgage payment. That is I think it was last time, it's either 0.80 or 0.85%, but that is basically worked into your monthly payment. And so it is what it is just basically an insurance policy for the FHA should the borrower foreclose. So it's a cost, and that's what makes it kind of, the FHA loan is, it's a riskier, I guess, borrower, they think, so that's where I would come in as a lender. I'm advising my borrowers, if you can get qualified for a conventional loan, then that's going to be my first recommendation, because it's just in the long run less expensive for you. But that, in a nutshell, is what mortgage insurance is. It's an insurance policy for FHA in the event that the borrower decides to foreclose.
And that is a perfect segue into conventional loans. So can you tell us a little bit about conventional loans and how they differ?
So the conventional loan, your minimum down payment traditionally is 5%. And there is a first-time home buyer 3% down program that I've been doing more of. I love that program, but basically the real difference is that the mortgage insurance you're still, unless you put 20% down, then you're going to be paying mortgage insurance on the conventional loan as well. And that is just built into the payment. But the difference is that mortgage insurance can be dropped once you're at 80% loan to value. And there is no upfront funding fee on conventional. So it's all around cheaper.
And this is the first time I've heard of that. So the conventional is allowing you to do 3% for certain cases?
Yep. You have to be a first-time home buyer. You have to take a home buyer's education course, which is online, and it's free. It's easy. It's just like an hour-long course, and it's actually really good to learn some good tips about being a first-time home buyer. And that's pretty much it. So it is a great program to get into. If I always say, I should say also, the caveat to the 3% down program is because you're putting less down, the mortgage insurance is more. It is more. So they're going to charge more because the conventional Fannie Freddie thinks, well, there's a higher risk because they're putting less down. So I would say the borrower that has assets and, isn't really kind of scrunching, money together for that 3%, go ahead and go 5%. You're going to get the best deal.
Absolutely. Absolutely. And along with the conventional, right, this is something that you're potentially, I think what we talked about is more one that you're going to live in, things of that nature. Can we go over to the investment portion? What about the investment loans? What are you having to put down, and what does that look like?
So investment homes are 20% down. And, looking at a difference in rate of anywhere between 0.5 point to 0.75 higher than a primary residence. So it is a riskier loan because basically Fannie and Freddie think, well, if something happens and things go south, They're going to keep your primary residence, and your investment property is going to be the first to go. So there is a higher interest rate charged on the investment property.
Okay, but overall, it's still pretty much a similar process, just a higher down payment, a higher interest rate.
That's right. I think it can be a higher interest rate. It's the same underwriting process as a primary residence. You just have to basically afford, the mortgages out there, any other liabilities, debt. So the real key difference is higher down payment, 20%, higher interest rate. Where the market's been shifting now, and Fannie and Freddie are kind of pushing people to put 25% down. And that's really where we're kind of going, or where we're frankly already at, is that to get a better interest rate, you really need to put the 25% down. Now, to meet the guideline to do an investment property, 20% is it. But, and I run comparisons for my borrowers. I'm like, well, this is what you're looking at 20% versus 25% down. So it is quite a bit of a cost difference, interest rate difference. Yeah.
True. I know they're changing it up. There's a lack of housing across the US and in a lot of major cities. And I get it, right? It's a way to try to allow more people to be able to get housing and keep it away from people trying to hoard all the houses, even though I'm one of those people. But we're not going to get into that. We're not going to get into that. One piece that I'm personally interested in selfishly, and I really want to come to you for guidance, is vacation homes. What are the guidelines around vacation homes as far as what you got to put down and what is required to use a vacation loan for a property?
I mean, a vacation home, so typically, the underwriter is going to be looking for a vacation home in a more or less a vacation spot. I mean, or you could a second home, we'll call it a second home. You may want to be closer to family. It doesn't need to be on a golf course. Everybody has their own reason to, I want a second home. I may live in Michigan, but I want to spend more time in Georgia, and I want a second home to be closer to my family. So everybody has their own reasons to live in a second home, but or to want a second home. But as a lender, you have to paint the picture for your underwriter. Like, why is the second home? Why do you want a second home? I always put a letter into my file just kind of explaining kind of the motivation. But basically, second homes have traditionally been 90. You can buy a second home for 10% down. But what's happening is that, and that's going to be coming up in April, that there's going to be a premium for a second home where the interest rates are going to go way, way up, unfortunately. And it is a situation where they're really, Fannie and Freddie are going to be looking at second homes the same way as they do as investment properties, because we are in a housing shortage right now. And it's unfortunate, but I think their drive is that they're trying to keep these homes that are available for primary residences. I just was on a call earlier today that it's pretty astonishing that within the country, the entire United States, there's only 800,000 homes up for sale, which is an extremely low number. And 100,000 of those are new construction that they haven't even been started. So really, truly existing home builds, we only have in available inventory across the United States today, 700,000 homes. So the drive is to kind of really make it more expensive for those that want second homes and investment properties, because it always was second home was treated the same as a primary residence, but that shift is about to happen.
And I appreciate the heads up, because I need to get a second home ASAP.
You do, yes.
Need to lock in a rate before April 1st. No, that's incredible to kind of hear your perspective. And one piece I wanted to touch on here before going to the fourth point that you have of things that you need to know to navigate for a loan is a jumbo loan. So when you're getting a primary residence, I believe there was some recent changes here, but previously before, a regular conventional loan for a primary residence would go up to how much from a dollar perspective?
Well, previously, or now, we look at my notes because it just changed. It's 647,000. Previously, it was like 430,000 or something. So just recently, it was a huge jump to the new conventional limit, which is 647,250. And so, which is going to help a lot of people. The median average sales price today in the United States is $500,000. So that is the average sales price. So it's not going to take much to exceed that conventional loan limit, but we do have ways to kind of help with that. We've got HELOC products, that it's just trying to think out of the box, a little creatively to be able to get the borrower, into a situation where they can, put 20% down on a sales price of $800,000, for example, put 20% down, get the loan amount under that 647 threshold. So you're just in mainstream conventional pricing, and then we do a HELOC. It's a simultaneous closing and do that at the same time. And that would be, your additional to purchase the house. So, but it's kind of an interesting time right now. I've never seen median house sales, national average of 500,000.
No. And Tracey, the creativity that you just displayed is why I reach out and love talking to you. But we got about 10 minutes left. I want to make sure that we can get to this final point and then open it up to the group for any questions. And the last piece, the fourth thing, was knowing how to navigate credit issues on your path to purchasing a property. And so what are some of the most common credit issues that you've seen?
Oftentimes people will come to me and they don't even know that they have a collection. It could be a medical collection. Maybe you were renting somewhere and you moved and, oh my gosh, you didn't give the forwarding address and they didn't know how to reach you. And then you have a $150 collection on there. I would say the biggest piece of advice I could give is always pull your credit once a year. And if you go on annual credit report, even if you go on free credit report, I always say it's important to get your score. So, and Credit Karma is not an exact science. They're not pulling your credit. So I have an account myself with Equifax, and annually I pull it, because if there's a collection out there and they can't find you, you don't know what's out there on your credit. So, typically the cost of pulling your own credit is about $40, and you just pull that and pay it, and then you get all your scores. You pull a tri-merge and do that annually. I see small collections, and it's an opportunity to just pay them and move forward. The collection's not going to go away, but it'll stay collection paid as opposed to unpaid. And I always say and advise clients, look, at this point, if a collection is out there, the damage has been done. Now you can take care of the debt, but there's not much you can do about it, because I can promise you they're probably not going to reverse that unless it truly was wrong. They're not going to take it off. But the best way to fight any kind of bad credit or collections in the past is just good credit. And if you'd like, I could touch on kind of like what I suggest for people to do in terms of credit.
Please.
Okay. So, typically, always have at least 3 credit cards that you're using. And, use those credit cards sparingly. I'm not suggesting you have a running balance. You're basically just tanking gas and groceries and pay it off every single month. And then you're really playing what I call the credit game. And you're gonna really kind of keep tracking, your score on Credit Karma, which is, it's not an exact science on Credit Karma, but it's a good guide where basically you're able to say, okay, I'm tracking my score going up every single month by just putting away my debit card and charging stuff, but I'm paying it off every single month, so I'm not accruing any interest. So, opening up credit, using them, installment loans are not the same as revolving. So you're going to get the biggest bang for your buck in your credit score by opening up and using credit cards minimally and paying them off every single month. Because an installment loan, for example, a car payment, it just doesn't help your credit as much as a revolving card does.
True. Agreed. And 2 things that you hit on that 100% in behind is, 1, checking your credit. I can tell you that I didn't used to do that on a consistent basis, but I've gotten into it in the past couple of years, because When I went to buy the house that I'm sitting in, I actually tried to buy a house before that didn't work out, but I bought this one. And my credit score all of a sudden was dropping, and I had no idea why. And then they checked my credit, and the person told me, hey, there's like a $125 water bill from a property you own in Louisville that wasn't paid by the tenant that moved out. And I'm like, hold up, what? You guys just hit me up. I would have paid that immediately. And so it was one of those things where it was dinging my credit each month. I had no idea about it. And when they alerted me, I was able to call them, get it paid, get it corrected, and now we're back up. So definitely agree on checking your credit. You never know what can hit. And then also the piece around increasing just your credit card utilization, or as far as the limit that you have. I know that when I was purchasing my first house, I had a credit balance that was roughly 50% of the card. And what I ended up doing was just increasing my balance, doubling it, and it dropped my utilization lower than 30%. And that started boosting my credit as I continued to pay it off. So,
right. Yeah, the magic number is 30%. You never want more than 30% on a credit card to the high credit limit, because as soon as you go to that 30%, all of a sudden it's negatively impacting your credit score.
True. And so with that, I want to go ahead and open it up to the group. Any questions from anybody on the line for Tracey?
The PMI in regards to the conventional, you said that it was like a 20 to 80 to drop it off?
80% loan to value, that's correct. So once you get actually more like 78%, the banks like to see just slightly under 80%. But if you have a mortgage and you're still paying mortgage insurance, and you have a low interest rate, you don't need to necessarily refinance to get your mortgage insurance removed. So you can call your lender and talk to them about getting it removed. There is a process to do that, and normally it is just, they'll either send an appraiser out or a real estate agent to do a BPO, basically just triple checking, making sure that the value's there and the home is in good condition, all that, and then they'll just drop it off for you.
So let's say I bought a house yesterday for 100,000 and it shot up to 250. If I get it reappraised, that means I could just get it reappraised, send a reappraisal, and then drop the PMI, correct?
I think that there is a minimum, and I don't know the answer to that. There is a minimum amount of time that you have to keep the MI on the loan. It might be 6 months or something. 6 months sticks in my head, but I would go ahead and just check with your lender and call them and see what their process is.
But the concept is that bearing the 6 months, if your house get appraised at 80 to 20, you can actually call up and say, hey, listen here, I have 80 to 20, and we can get it removed, correct?
That's right. I mean, if your home is at 78, 80% loan to value, you can get your mortgage insurance removed. That's right.
Okay. Mm-hmm.
Any other questions for Tracey?
Hi, I have a question. Can you hear me okay?
Yes.
Okay, awesome. So you've hosting this, and also thank you for sharing so much knowledge here. I used to be a loan officer, but it's been a long time, so I forget most of the information, but so it was a really great refresher, and learned a lot as well. But I just was curious. I'm thinking about working with my partner to buy another home. And I've been just thinking about a HELOC, although to take out equity to help with the down payment. Although I'm just kind of curious on what your thoughts are given the market. Are you seeing any lenders at this point allowing for getting a HELOC without taking over the first?
That's a good question. And, for you to know as well, but it's like in that scenario, what I would have asked her, if you're in a position, for example, and that your house is maybe free and clear, and you're like, well, we want another house, right? So you could tap in to your equity on a home and actually do, like, if it's a primary residence, it would be cheaper than buying an investment property or a second home. So you're doing a HELOC as long as you're max 80% loan to value, you could actually beat the system that way by drawing from equity on one property and paying cash for an investment property, or a second home. I have a really good contact for HELOCs as well. I think they're just becoming more and more relevant now, given our current circumstance. And so,
yeah, that plus, and I love that. And the key is paying cash for a property, and then you can refinance out of that if you need to later. And because we're in this inflationary period where I literally saw this home I'm sitting in go up 15% in a year, which is crazy. You're going to have some equity if you're buying homes, if you're out there, that you can use to buy more homes and kind of acquire. It's almost like it's getting harder for those first-time home buyers to even get in. When you talk about an average cost of $500K, my first home was 190, and I scraped together everything to get that. So
I know. I feel bad for people that are just trying to get in. I will try my hardest to work with anybody, but it's like it's just tough right now, being a first-time home buyer. But it is another way to think about it, that you're able to kind of like be creative and draw from a property that has a low loan amount and a high value, and then you could say, I'm just going to do a HELOC on that. Draw the money for that. I'm going to go pay cash for this property, and do it that way.
So to that point, a question that I had is, are you able to get HELOCs on investment properties? Is there a way to do that, or does it have to be your primary home?
I have not done one on an investment property. I want to say, I was just, because I made some notes to myself. I on HELOCs earlier today. I think you can, but I'm going to circle back with you on that. I'm not entirely sure. I mean, obviously, yes, on primary residence, but wouldn't see why not. That you couldn't do an investment property, because as long as you're max 80%, bank doesn't care. So the equity's there, but I'll circle back with you on that tomorrow.
Thank you. And then another piece that came up that I wanted to talk about is, we talked about motivation and things of that nature, but one other piece is for the listeners that are going to hear this in a couple of weeks. It's going to come out, I believe, in April. What is something that you're working on, a goal that you have for this year that we listeners could help you out with? What are you working on, and how can we help you with your goals?
Well, I mean, as always, the goal is to grow the business, and and my good fortune of meeting you and kind of getting on this is my first podcast, by the way. So this isn't something that I would naturally be drawn to, but I think my goal is to kind of like, I'd like to be more involved and in these kinds of opportunities. And this is kind of frankly where we're moving, with just society today, online and podcasts, and scratching the surface. There's so much out there available. So, my goals are always pretty much the same. I'd like to grow that segment of my business to be able to reach more people. But at the end of the day, it's about, getting people into homes, and that to me is why I do what I do. And it's the most worthwhile piece. And so if I, in any way, shape, or form, can take, the knowledge that I have and just talk about the things that I know, and it helps people, then I'm happy to do that.
Tracy, I think you've done more than that. And just in the short time I've known you and the different instances we've worked together, it's truly been a pleasure. And again, I can't thank you enough for joining the Ekabo Home Financial Freedom Mastermind Group podcast. Yes, that's a mouthful. And dishing that knowledge, because this is one that I think a lot of people are going to get value from. And just for the listeners, we are going to include Tracy's contact info in the show notes. So when this episode does come out, when you're listening, go ahead and shoot an email over to Tracy. Go ahead and connect. You can ask her questions directly. One last piece, and this is one that kind of popped in my head when you were talking a little bit about where we're heading, right? And again, this is not legal advice, anything like that. This is just one person's opinion. But if you had to look into your crystal ball, right, and look at, hey, where's the mortgage industry heading? You already mentioned a couple nuggets as far as vacation homes almost getting treated from an interest rate perspective like investment homes. What are you seeing happening over the next 6 months to a year or 2 years?
I think we're just going to be kind of in the same place. Unfortunately, I think our inventory is just going to continue to kind of dwindle. New construction is not hitting the market as fast as we need it to because we have supply chain issues. So it's just a cascading series of events that we're unfortunately in, a tough time, in terms of inventory. But it's not going to last forever. As we continue to move past the pandemic and the supply chain issues kind of resolve themselves, and it's just going to take time. But I think for the next six months to a year, I think really we're probably just going to see much of the same where we are right now. And it's not to say that there's not good opportunity out there. There is. There's still contracts being written. There's houses being put on the market. So it's not dissuading people to get out there and to look by any means. But it's just going to take a little bit more patience.
Done. And that was a peek into Tracey's crystal ball. Again, when this episode comes out, go ahead and like, review, and hit that follow button. We appreciate all the listeners. Tracey, we appreciate you. And we're definitely going to look to have you on a future episode a couple months down the road after a couple things shake out and the interest rates start changing to get some advice. So Tracey, thank you.
Good. Look forward to it. Thanks, Nate.
See ya.